Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Maddie Radner, Director on the Nasdaq Market Intelligence Desk, Joe Cavatoni, Senior Market Strategist at the World Gold Council, and Rene Reyna, Head of Thematic ETF Product Strategy at Invesco. And we're here to discuss the ETF trends shaping today's market, what's behind the demand for gold, and we'll also take a look at IPOs and the outlook into 2025. It is great to have everyone with us. Welcome back to Trade Talks. And the commonalities with these different themes, Joe, really is what's happening with the macro backdrop.
That's right. I think it's definitely a very interesting backdrop. I don't think anybody saw the outcome that we have seen with respect to ultimately the political outcome in the US. I think that's kind of complicated matters quite dramatically as we go into the end of year and into next year. But what's really fascinating for us, and specifically around the gold market, is that it's really boiling down to two big markets that we're keeping a very close watch on. What and how the policies will play out in the US, how that will dovetail into monetary policy and other factors in play, plus what's happening in the East, because part of what's been driving our demand for gold has really been an East and a West story, a global story. So we're keeping close eyes on what's playing out with China. And all of this is interwoven into this very interesting macro backdrop where you've got policy, political outlooks that are very challenging, including geopolitical tensions. You've got macroeconomic issues that are pretty substantial and debt burdens that are very serious and significant. And lastly, you've got these unknown unknowns. We were just talking before we got started here about flare-ups, whether it's the fall of the Syrian government, whether it's a situation in South Korea, whatever the case may be. These things that continue to pop up. We call them black swans, but now they're more common.
Yeah.
So all of those things are laying down a foundation for some very challenging times, but very interesting times, boding well for assets like gold, where you need a safe haven, plus some opportunity to see how you can balance out a portfolio.
Yeah, and it's interesting, Rene, because all these different dynamics impact all the different thematics that you're covering at Invesco as well. So not that we could pick a crystal ball and figure out, which of these 60 thematics, have the most exposure to that, but what type of trends, what kind of demand are you seeing from investors as it relates to whether it's strategy, methodologies within the ETFs?
Sure, so I think as the year winds down, I think some of those comments, I think investors are looking to reallocate and asking themselves, where directionally should we go? I think the post-election results were pretty surprising, I think, to the upside for the most part, and then here we are in December, and we're seeing a little bit of reversal of trend. I think we say 11 straight days now where there's more laggards in the S&P 500 than gainers, the first time since 1996. And so I think investors are a little bit cautious right now after experiencing such a really strong year. I think as we look next year, I think generally speaking, we see the environment or appetite for risk or risk-on environment. Most likely see perhaps a rotation into some of the other sectors in the market. I think one other trend that maybe we'll talk about later on today too is the demand for option income ETFs that we're seeing as well. Perhaps investors looking for income, want to take risk off the table a little bit, but still stay allocated is another interesting trend that we're generally seeing right now.
I mean, especially with all the options products that are available now. There's more choice for advisors, for issuers, for managers.
There's, and overnight, this space has ballooned. In 2020, I think we saw about $3 billion in assets in the sort of option income ETF category. It's just under $100 billion if I look at yesterday's close. There's 105 total products now in this particular space. And flows are about 30 billion year to date, 5 billion so far over the last 30 days. So I think that tells us investors are a little concerned. They want to maintain their exposure to the markets, right. But why not get paid to wait? And these option income ETFs can be a great way to achieve that.
That's a theme we're hearing a lot of. Now, we've had a record-setting year. We think we've hit 40 record highs in the price of gold throughout the course of 2024, and we're hovering at around 28% return for the year. Magnificent performance. Yet the conversations haven't stopped in terms of people saying, let's take a look at how this can help me out. I think they think it's frothy. Mm-hmm. I think they're concerned around the shocks that can ensue with their portfolios. I think we had a few of those moments over the course of the year, and they're looking at gold, even at record highs, expecting it to continue to have upside opportunity to grow, but also not really having a good handle on how to time the market, because I think that's been the real big challenge. I think in case of for the case of the gold market, we had an early surge in the price and people were confused by it because they were expecting monetary policy in the US Fed cuts to be the biggest driver, the strength and or weakness of the dollar to be the biggest driver, and it hasn't really played out that way.
And you said it's up 28%?
Yeah.
Which is interesting because the S&P 500, by the way, is up, what, 27, 28%? And that was kind of why everyone was scratching their heads this year, why it's moving in tandem with each other.
Well, I think there's a lot at play, in particular for the gold market. Number one, the risk appetite globally, central banks, which we've talked a lot about over the times that we've been here on the program, but also the Eastern investor seeing opportunity to diversify. And that diversification is, again, back on the table with people and clients that we're talking to in the US. They're looking at how do I protect myself? How do I cover this risk? Because while I like the returns, I feel it's frothy and I can't really buy that protection.
So Maddie, speaking of risk on, the expectations for the IPO market, let's even call it secondaries as well. There's a lot of money that needs to be moved on the sidelines this year. What are you seeing, do you expect that to play out in Q1 and Q2?
Yeah, I think there's a lot of optimism heading into 2025 when we look at the IPO market. So across the US exchanges so far, we've now seen 227 total IPOs this year, including 55 SPAC IPOs, which we've seen a little bit of an uptick there and a little bit renewed interest in SPAC IPOs. We kind of rounded out the year with last week's Service Titans IPO, which raised $624 million in proceeds. 2 weeks prior, we saw Pony AI, which raised $260 million, and they are a Hong Kong-based company. So we're seeing renewed interest again in different areas tapping into the US market. So we've now seen 40% more IPOs than where we were this time last year. And something that I do think is worth noting is there is definitely a backlog in PE-backed IPOs that are looking to move forward, specifically in 2025. PitchBook actually highlighted about 50 potential PE-backed companies that are set to exit through an IPO this year. 19 have already filed. So things are looking good for companies and investors looking to make a profit on their investments in the IPO space.
Yeah, it's almost a self-fulfilling prophecy. I mean, they have to move the money around. It can only be locked up for so long. And of course, the private markets and then the valuations that we saw in 2021 and 2022 having that reset, I think was actually a good thing for the market. To bring it back into perspective, think about governance, clean balance sheets, the right management teams, having the right advisors. I think that's a good thing for public investors at the end of the day so that they get to participate and not be left holding the bag, if you will, when these exits occur.
Absolutely, and I think to the point, you mentioned IPOs, and I think one other aspect we're looking at, mentioned post-election, is just around the regulatory backdrop, interest rates, taxation, but M&A on the bank side, for example, as well. And I think that's another area we've seen a segment of the market. So financials, clearly have rallied quite a bit this year, especially post-election. We have indexes that track the top banks in the U.S. And I think that's where we're seeing sort of the call or the trade there is really, increase or lax regulation, increased M&A activity. And then just generally speaking, capital markets should generally improve with this kind of backdrop.
Yeah, it certainly should. Joe, I think part of the challenge is there's so much conjecture that's out there. I mean, the new administration isn't even in yet. There's nothing to benchmark it against. The 100 days haven't happened yet. There's a lot of conjecture out there, but I'll tell you, I was in Asia for the US election, and to see on the ground the response when it was a clear-cut win, a concession was going to take place, it was a collective sigh of relief in a way, because that one piece of uncertainty was removed, and it wasn't something that was going to be ongoing for a number of months.
Yeah, look, I think it surprised everybody. It was quicker, cleaner, and clearer than anybody anticipated. The market had kind of priced that in, but I think it moved very quickly on from that. And actually, what's really fascinating is that the glide path for the potential for success around what the administration wants to introduce, plus the Congress's support for that, could be quite clear. Now, the challenge is that they've already put so much on the table. You've got the entire, the U.S. economy, which includes the debt burden that the U.S. is carrying and that unsustainable level of debt, and the strength and or weakness of the dollar and its role as a reserve currency. Now that's item number one. Second, you've got our role in geopolitical landscape, which is going to be a big question and could be very influential on how things develop in Europe. Third, you've got the tax structure, which needs to be dealt with in 2025. Many of the benefits in the tax regime right now are expiring next year, whether it gets done in one or a multiple number of different moves. in terms of a bill or a tax bill. That's to be seen. And then lastly, the Trump administration wants to be innovative, accusing the Biden administration of not being innovative enough. And you try and bring all of that together and stay organized, there's a ton that needs to get done. You need to get the appointments done. I think the first 10 weeks of the year for us in the gold space, we're probably going to be sitting and waiting, because I think bigger for us, and our research shows this, you need 6 months in to see a policy get voted in. You need to see the policy get bedded into process. Then you'll see the implications of that. Like, we're hearing about tariffs. Is that a good thing or a bad thing for the gold market? It depends. It could be a sticky inflationary type of outcome that, as a result of tariffs that could come into play. That's a good environment for gold. But it could also be a bad thing if it impacts the logistics and the ability of people to actually get access to gold. Probably lesser of an issue for us, but could be an issue for something like silver. So to be seen how quickly it all plays out. But again, we see that first 10 weeks of the year very much in line with what you're talking to, which is people trying to assess, hedge, figure out risk, and then move into more sustained kind of allocations of how to deal with their portfolios.
Yeah. Well, I mean, Maddie, not even that, but for corporates, they need it to be able to determine their guidance, right? If you're unsure what tax policy is going to look like, how tariffs could impact margins, how those, costs get passed down, your input cost. I mean, you're our small cap guru here, and your companies they're predicated on everything with input cost.
Yeah, we saw small caps really rally following the election. And that's because they could really benefit from less regulation and lower interest rates. They're now down about 4% from that November 25th post-election peak. And that's because more near-term kind of implications are coming into play. So while a December rate cut is still expected, the 2 to 3 that we're looking at in December in 2025 might be in jeopardy, just as we continue to see more economic data come out, maybe a little bit stickier of inflation, and a strong economy. So that's kind of maybe why we're seeing some of the small caps stall in the near term off of that rally.
Yeah, I would agree with that. I think, looking outward to 2025, fast forward, we may perhaps after a quarter, we should hopefully start seeing a rotation, right? So more value companies participating, but then also down the cap spectrum, mid caps and small caps. But right now, I think to the point around, gold as a hedge, I think that's, where we see sort of investors sort of concerned. I think right now the question is, do I buy this dip? Do I start removing profits off the table? I think this is where kind of like those option income strategies kind of come into place, because you can kind of get both. You get the market participation, you get that downside risk protection. You can use it in combination with gold and have it as a hedge in your portfolio. I think the other thing is we're seeing these strategies evolve, and I think one of the other trade-offs or outcomes that are interesting is just around we're seeing now you can have income outcomes. So if you want a particular target, you can achieve that. And then also your market participation outcomes. We launched QQA, Invesco Income Advantage ETF, and I think what's unique about that fund is the ability to sort of target a particular outcome in terms of market participation. So generally we'll look at sort of like a 0.75 beta. So you start thinking through and say, okay, I can achieve market participation. I know what I'm going to expect on the downside. And then that distribution yield in that fund is 10%. That's kind of what you target. Those are pretty good outcomes, I think, while you're kind of waiting it out and hedging with other strategies in the portfolio.
Which is interesting, because going to 2024, there's this expectation that we were going to get 6 to 7 rate cuts. Never materialized. Market's up 27, 28% on the year. Nasdaq 100, 33% on the year. So I think it depends on where the market is focused that day or within the news cycle.
I think what it has demonstrated, at least from our vantage point, which is while you might be convinced that certain single or double factors might be influential over a certain asset, most people fixate on dollar strength or weakness and rate environment when it comes to the valuation of gold, but you have to be much more switched on with exactly what's driving flows. China, central banks, consumers, international investors have all driven that price higher. And actually, yes, monetary policy matters, but it matters in the context of flows in the US for gold. And actually, we've seen the result of a higher interest rate environment, a stickier environment where we hang around up at the higher levels. But now it's moving off, and the sentiment is starting to shift. It becomes an opportunity cost discussion. So we share the view that it's probably going to slow into next year in terms of the rate cut environment. 100 basis points is probably where we're going to see it. But it's not just the only factor that's going to drive things. You got to be a lot more dynamic in understanding what's moving markets, because it's just not one thing. We're keeping really close watch on China.
Yeah.
Now, everybody's downplaying the significance of their policies and how they're rolling it out and not pricing that in. I think it's naive to think that way, because the two big dogs in this hunt are going to be the US and China. Everything else can fall in place after that.
Right.
And China policy, can it stir up the stimulus? Can stimulus bring back consumer spending? And how does the consumer behave against a backdrop of a challenging investment environment? It's big time in terms of what's going to play out.
But then you have that balance when it comes to fiscal policy and inflation as well. I mean, when you start to insert that stimulus into the system, it essentially unravels all of the tightening efforts that have went into it. I don't know. I feel like, you know, looking at the economic environment right now and the position that the markets in the economy are in, 4 to 5 cuts kind of seems aggressive to me.
I would agree, and I think that's kind of why we see sort of a little bit of a wait and see approach.
Yeah.
You know, the employment data still seems relatively strong. The consumer, as we get new data coming out, the consumer still seems strong. However, you know, perhaps there's some cracks in the system. Again, going back to some of those employment numbers. So I think we're all sort of taking a wait and see approach. And then again, we'll see when Donald Trump takes office and starts implementing some of his policies and kind of see how that impacts the marketplace.
They're gonna, no pun intended, but they're gonna trump potentially the magnitude that monetary policy could have.
Mm-hmm.
Right.
Look, I think getting fixated on the number of cuts or how how much, I think the important factor is if we're on a trajectory of rate cuts, then we're in a good environment, particularly a favorable environment from an opportunity cost that favors gold. I think getting too fixated on how many, how much.
Right.
You're missing the big
I would
story.
agree. Like if it gun to head, I would say geopolitics, right?
Geopolitics
because
are
to
a
your
big
point, there's that
factor.
dichotomy there. To the U.S.,
Right.
China, depending on how either those policies go, EU, well.
Yep, geopolitics, but also how does policy from the U.S. and that protectionist kind of mentality unravel and unpack and actually get on a glide path of being implemented into 2025, and that will actually be much more impactful,
Right.
particularly into 25.
I mean, implementation and execution are very different than, you know, trying to devise policy via social media. But Maddie, what's interesting is, and we saw this in Trump's first administration, he really does bench himself against how the economy and the stock market are performing. So
yeah, I mean, I think when it comes down to it, 2024 really has been an incredible year. All major indices are up double digits. We probably wouldn't have expected that heading into the year. So, and on top of that, the IPO market is starting to open. There's a lot of interest there. So I do think there's just a lot of optimism heading into 2025, especially as we are expecting less regulation, lower interest rates. And so when we think about our public companies, they should benefit from all these new regulations.
yeah, and to your point on M&A before, we have a couple minutes to go here, Joe. I want to get your thoughts on digital assets. Clearly, we've seen the performance with the new administration that's coming on board. You know, certainly bullish around getting that framework worked out. What about that in relation to gold, the impact?
So a lot developing in the industry around the digitization of gold. You know, we've got our Gold Bar Integrity program where we're tracking and tracing all forms of gold. That database is being rolled out by the London Bullion Market Association and also getting embraced by all the major players in the industry. But what's really unpacking and really looking very cool right now is the work that the industry's doing around figuring out the right way to digitize gold, not just giving another digital version of accessing gold like a token, but really figuring out how to dematerialize it. And I think that 2025 will be a big year for us. I can't give too much intel right now because there's a lot of work that's being done, proof of concept. But what you should be expecting is dematerialization of gold, meaning that it can sit where it needs to sit, but you can actually change the receipts at a wholesale level and actually really transform the way gold trades. Because right now, physical gold is kind of clumsy when it comes to being used for collateral outside of the exchange environment for futures. And we want to unpack all that. We want to make gold as liquid and as fluid an instrument in the collateral sense that you would see with equities or maybe with bonds. And that's what's going to come into 2025. So that for next year, big market.
Yeah, it's another dynamic as well we have to pay attention to for sure. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.